Okay, so today we continue with the we'll still continue with group accounts. It will start getting a bit complex as we move on, but the foundation is very good, so you will not face any problems going forward.
Okay.
So we now move on to look at another segment that you will always find in consolidated or consolidated questions or group accounts. You may find a segment on joint ventures, which is obviously guided by, I think, IFRS 11, or associates, which is also which is guided by IS 28. So first we'll look at at associates. We have looked at a business transaction where one party buys over 50% of the interest of the shares in another entity. And that entity that buys more than 50%, we did actually establish that these will be called parent companies, and the company that has been acquired will be called subsidiary entity. And the component that hasn't been bought by the parent company will be regarded as NCI, which is non-controlling interest. But there's also a possibility that a company would buy less than 50% or 50% and less. So you may have issues of, is it a joint venture? Is it an associate? But today, let's look at the associate. The rule of thumb instructs, it is very instructive, that anyone who has more than or between 20 to 50% is regarded as an associate. But then we should not just be blinded that it should always be above 20. There's a possibility that it could be around 19% or even 18%. The key term in this particular situation is significant influence. So significant influence is where you take part in the decision-making of the organization. That is the financial and operating policies or directions of the company. You're part of that particular decision. So let's look at situations which would make a company qualify as an associate. There are about 5. Other than you acquiring more than 20%, but below 50% of the stake in one company. So the first situation will be representation on the board. Representation on the board at least would give you an opportunity, if you're coming from what we call minority, would give you an opportunity to voice out even your anxieties in terms of decision making. So you have significant influence. What you don't have is control. And this is one thing that politicians don't understand. Those that actually finally are given the privilege to rule over their own people. For example, in a country like ours, you have over 72 ethnic classes or groups. If you bring in Chinese now, we are even maybe 74. So for a tribe like where I come from, the Ilas, we are less than 2% of the total population. So it is just wise that the cabinet that actually sets the policies or make tough decisions in the best interest of the economy, that the Ilas as well must be represented. So they may not have the control because they cannot swing the tide where the elections will go to. No, they can't. They are less than 2%. But sitting on that cabinet, it means that you're giving them an opportunity to be part of the voice or decision-making of the company, of the country. You then look at Zimbabwe. Zimbabwe, first you have the Shonas, who could be in the majority. Then you have the Ndeweles, then you have the Tongas. Which other tribes there?
We also have the Sutus as well.
Yeah, but the Tongas are there, isn't it? From the
Yes, they're there.
Nazongwe Kariba thing.
Yes.
So now one will not say, no, we cannot in this cabinet, we'll only have the Ndeweles and the Shonas. Yes, they may direct the direction. They may be influential in where the country goes, who is supposed to be voted in as president and all that. But out of respect, they will also need to look at those who have a smaller stake. To be part of that decision making, which is at cabinet level. So what it means that at cabinet level, you have to try by all means to have all these. It's not possible to have all ethnicities in there, but you can cluster them. So if it's in Botswana, if you have the Karangas, even just one of them out of the 7 cabinet ministers that you have would still say that you are an associate, that the Karangas are associates to this particular country because there's some representation on the board. They have significant influence. They may not have control, but they have significant influence. So this is what we are looking at when we're talking about associates, so that as you go into the exam, memory peg with a cabinet in a particular country where you have different ethnicities and you cannot just have 2 or 3 ethnicities sit on that cabinet. You should actually be a bit representative in the way you do it. You should be deliberate in the way you pick your cabinet members or people are going to become your cabinet ministers, so that as they sit on that decision making, which is basically the board of the country, there's all, at least in quoted, all ethnicities should feel that they are part of the decision making and they are part of the direction in which the country is supposed to head to. So that is one on the representation on the board. I hope you can memory peg it well without going back to books and start reading.
Yeah. Yeah. Yes.
Secondly, participation in the policy-making process. Let's give an example of a constitution making. I don't know, and I need to do a bit of some research on Zimbabwe, the type of constitution they have, whether it has controversies and whatnot. But in Zambia, our constitution is more of a debate generating document because it has a lot of confusion in it. But then, if today they decide, the new government decides to come up with a new constitution, it is fair that almost everyone, if not everyone, is represented through one, maybe ethnicities, two, maybe gender, three, maybe different abled and normally abled. At least there should be classes. They should be involved at least to participate in policy-making process. In there, maybe they can be bullied because they are a minority, but they should be part of the policy-making process. We recognize the fact that they will not have control because they are not in the majority. They do not have majority stake. They are just associates who have actually bought more than 20 or between 20 to 50% of the shares. We recognize that, we get it, that they cannot have control. But what they can have is significant influence. And significant influence will come in through their participation in policy-making process. So a representation on the board and participation in the policy-making process is almost one and the same thing. So if you are mind mapping, of course, you start with the representation of the board. First, you memory peg with ethnicities and sitting in cabinet. That is the first thing where then you bring it to the company, that it's basically the board. So if they sit on this particular board, on this cabinet, what other thing is there? Why they are sitting there is because it's key for them do this. Sorry. This point and this point, you marry them. So if you are doing mind mapping, not memory pegging, first you memory peg. These things you should be researching, guys, on memory pegging and mind mapping. You will never struggle in terms of cramming. You don't need to overstudy, Victor. So memory pegging first.
All right.
A question on associates. They ask you about associates, how is an associate, whatever, and all those things. The first thing that comes into your mind is first, maybe we talk about the Ndebelés. If they are not the majority in Zimbabwe. So you say the Ndebelés, they'll have to sit part in the cabinet as well. Then now you mind map it. You say in a company, what does this mean? In a company, then it means that there should be body representation. So if they sit in the board, those that have bought between 20 to 50% of the shares, they have board representation. So from body representation, what do you expect? Then now you do what you call mind mapping. Why should they sit on this board? If they sit on that board, is it okay that now they have significant influence, they are associates? No, yes, they sit on the board, then these people, they shape policies. They are involved in policy formulation. So meaning that these 2 points, they are the same. So you don't need to know the second point. All you need to know is your mind map, you have body representation. So if they sit on the board, then what? They are sitting there so that they participate in the policy making process. So you don't need to know all the points. You don't need to go into a book and start writing all these points. No, you will just need to have one. And once you have that 1 point, you will now start mapping it and creating it more points.
Yeah, it's understandable.
That's mind mapping, and their websites. I remember, I think in 2006 or 7, I actually subscribed on the mind mapping website, and it was about $20 then. I don't know how much it is, just to help you on how to create points without really reading so much. So the second one, material transaction between the entities. So there may be these material transactions between the entities. They may also do on-lend loans and all these other things. That in itself, it actually gives them significant influence. And this can still be related, if you mind map it well, it can still be related to interchange of managerial personnel. We see it so often, most of these companies. Even when you look at, say, for example, you look at Zambia's River Authority. This is basically an entity where Zambia is 50%, Zimbabwe is also 50%. And there's an interchange of who becomes the CEO. This time now is with Zimbabwe. Then the CFO will come from Zambia. At some point, it will be vice versa. I don't know if you know about that, Victor.
Yeah, I know the issue that we own 50%, but the issue of the interchangeability of the CFO and the CEO, I didn't know.
So there's this interchange that always, if there's if the CEO will be from Zimbabwe, the CFO must always come from Zambia. At the end given point when the CEO will be Zambian, you cannot also have the CFO come from Zambia, for a simple reason that you are looking at decision making on the policy, on financial and operating. So they cannot come from one side. And that's the best example of what an associate may mean. But there's also, you will find a situation where some companies, where there's interchange of managerial personnel. I'll give an example of Zesco. Zesco has a stake in a company called, what is this? Electric Transformers, Sawid. So some of our colleagues from Zesco, what do you call, there's a term that you use. They are, you know that term. They are seconded.
Seconded.
Yes, they are seconded to work at electric, whatever. So that interchange of managerial personnel, it does actually show the significant influence that we're talking about. That the fact that you're able to take your own personnel, second them to go and work in that company, you have significant influence. Then provision of essential technical information. So that provision of essential technical information, yeah, for example, there's now Batoka Gorge project, the hydro project. I need to be about how many megawatts? It's quite huge megawatts. I don't know, it's 2,000 or so megawatts. There is interchange in terms of provision of essential technical information that is coming from the technical guys from ZESA and also from ZESCO. So it's clearly so that where this SPV is going, the special purpose vehicle that will be created, both parties will have significant influence in the financial and operating activities of that one single entity they're going to create as an SPV. So on this issue, this is how you can mind map, memory peg, and have these points without necessarily regurgitating them. Is it okay?
Yeah, it's okay.
Yeah, it's okay.
So an example of significant influence. Chenjerai, my good friend Hitler, may his soul rest in peace, acquired 19.9% of the equity share capital of Kutizai. I remember Kutizai when he was, I think he was beaten during that time of the crocodile, when they were now getting power. But this guy was a youth leader, so I remember him doing some frog jumps. Is this around?
Yeah, it's around.
Okay. So let me read the question. Chenjerai Hitra Homes acquired 19.9% of the equity share capital of Kudizai at the start of the financial year. As part of the investment, Chenjerai has 2 out of the 8 seats on the board of directors. Advise Chenjerai how it should account for the investment in Kudizai Chipanga in its financial statements. What would be your advice? I will start with Luke.
I think 2 out of 8, so that's less than 25, that's less than 50% of the seats. So obviously I would advise him to account for it as an investment in an associate.
Okay, Victor.
Yeah, I think that's the same. 25% representation, our account it as an investment in associate.
So the first thing that you do when you're writing, if you say, depending on how many marks it is, if say it's 5 marks, first you debunk this theory here. Yes, as much as the rule of thumb is that it should be 20
to 50
to 50%. That is given, you write a line on it, right? That if you are to look at it from that angle, this transaction may not be regarded as an associate. However, this out of that shows that you're part of the policy making. You're part of the policy making because you sit on this board. So you're going back to those points that you have. You remember those 5 points?
Yes.
And 2 out of 8, you can even do a percentage of this. So it shows your voice. So based on this, it basically shows that you have a say in the financial and the operating. Trajectory of the company. Therefore, it qualifies to be an associate because you finish up with the term that they want is significant influence. Then you get all the marks. Actually, on theories, I want on the theories, you don't leave any stone unturned.
Okay.
And having been a marker for years, so I know how these guys might. Don't write sentences that go on like paragraphs. Just a small point, go to another point, go to another, like bulletins, small. Don't waste a lot of time. These guys, they are so quick that they just do like this. If they see you write something like that, they may not have time to read it. Because they have a lot of scripts. So that's how you get them.
Okay.
Mm. Mm-hmm. So this is just basically the model solution, and they'll be explaining, because here you're just at the academy, you're trained on how to pass exams, not to waste time. You don't need to be gifting that association for free. So I think an associate is usually presumed if ownership of between 20 and 50% is evidenced. So initially it would appear that Chenjerai, who's whatever, does not have influence over Kudizai Shpanga, is not there for an associate. This is the first thing that you start, because the examiner wants you to try to direct you to this 19.9%. So you first debunk that. You agree, okay, if it is like this, in this case, then it is not going to be regarded as an associate. Then you go on, like we had discussed, further investigation into the business relationship reveals a bit more with regards to the level of influence that Chenjerai actually exerts, regardless of the percentage ownership, which you get it and you have not acknowledged it. Given that Hitra has 2 seats on the board of directors, then it will give them the ability to make themselves heard at the board meetings and have influence over the decisions of the other 6 directors. Hitra should therefore treat Kudizai as an associate company and equity account for its 19.9% holding from the start of the year when it was acquired. So you have seen the thematic flow, isn't it?
Yes.
Yes.
If someone comes and says, and this is how you can even memory peg in the way you should be able to answer questions. If someone comes and says, in this village in Iwange, old people, we found 3 old people who are witches. They practice high-grade witchcraft. Then you go to Wange, you find an old person. Ideally, what should come into your mind is that the witch. Then after you do a lot of research evidence, you find that that witch, that old lady, sorry, she's a Catholic nun. And she's more of a Mother Teresa. So you say, in this village, all the witches that were found by a witch doctor or discovered by a witch doctor, and they confessed for being witches, were all old. With the average age of 77 years old. The average age of 77. In this regard, this lady who is 85, who is 85, based on this data, should be regarded as a witch. However, the evidence that we have discovered and is traceable, auditable evidence, is that this lady, she is a Catholic nun. She practices Christianity. And she has her own NGO that focuses on helping the community. So with this evidence, we'll conclude that this old lady, she is not a witch. Kwamana, kipeto, fasila. So you're starting like debunking the first part, because you know the mind of the examiner, why they have put that 19.9%. So I agree with that. I agree with him based on the theory and based on the rule of thumb. Then move on now, start debunking until you come to your conclusion. Is it okay?
Yeah, it's okay.
Yes, it's okay.
So we bring in a component on working 6. So the question that I sent in Excel, that's the first one you'll start before that question that I sent last time. So you know the first working up to working 5. Working 1, we know that we first have to find the share percentages. I'm going to fix now. Okay, complete. So the first one, the first working, we want to know the parent company, what's the shareholding? The NCI, what's the shareholding? So it's just based on the shares split. Working 2, and these things should be in us loop. If there's anything that should be in us, it's these steps.
Yes.
So the second step, we know that the net assets in the associate, in the subsidiary, sorry. And there, what we are trying to do is to establish what was the net assets at, what is the net assets at report date? What was the net assets at acquisition? And what is the value at post-acquisition? Which you use those numbers into your goodwill, your NCI, and your group returns. So you will know that now the third point that you are going to, after knowing the net assets and the movements of your net assets in the subsidiary, will be to compute goodwill, which now becomes working 3. And you know, again, on goodwill that you don't need to even study to understand what goodwill is actually basically how much did the parent company spend, how much can we presume was spent by the NCI. We add it together. After we have added it, less the net assets of that subsidiary at the point that we're acquiring it, so that we determine whether there was any goodwill or not. Then we go now to working 4. On working 4, we know that we are dealing with the NCI. So with the NCI, there can only be 2 positions on the NCI. That is, at acquisition, what was that stake that the non-controlling interest acquired or is presumed to have acquired? We should be based on working 2 in that table on the net assets in the subsidiary. Then secondly, is the post-acquisition. From this post-acquisition values that we have, what is the portion of the NCI so that we give it to the owners who are the non-controlling interest in this case? Then we now go to working 5, which is group retained earnings. Under group retained earnings, In this case, if they are associates, we will need to get that profit of the associates and have it as part of the group retained earnings. If there were only any dividends that were given, we will still have to subtract that dividend from the group retained earnings. So we would have taken care of the profits that is coming from the associates, filtering out the dividends that are also coming from the associates, so that we have the correct GRE number, the group retained earnings number. Now, working 6 will be the investment in associates. Remember that associates are counted through equity method. What is this equity method? You don't go line by line because you're only getting a portion of the profit that has been earned. So you look at the whole income statement of an associate. If the profit was 10 kwacha, then you say from this 10 kwacha profit, how much is the portion of the associate? If it's 2 kwacha, then we'll get that 2 kwacha and add it to the cost of investment in the associate. But this 2 kwacha that we are picking, we are only picking after post-acquisition because the pre-acquisition has already been taken care of, or at acquisition has already been taken care of in the cost. This is your cost. This is your basically your purchase. Come in. Okay, bye. Morning. She didn't put sugar in here. Then whatever cost of investment that we have, because whatever element we get there, it goes direct in the first part of the balance sheet. And I'll explain how it works out. So from your balance sheet, please you serve me with your terminologies of statement of financial position. I don't know it, I'm an old school Victor. So for me, it's a balance sheet. So from the balance sheet, you have this first half, which we say it's your eyes. This is where you have your assets. Then you have this other half of the balance sheet, the last half of the balance sheet, which is the ears. This is where rumor mongering comes from. So we are saying that here, if you have the assets, this is where you have your assets, which we are able to see with our own eyes. This is where you have your equity. Teresa, you didn't put sugar in it. And abilities. This is where. So what you see, what people are able to see here is supposed to be funded by this. It's supposed to be funded by that. So even when you're trying to balance your balance sheet, always think of, if you come up with one transaction that affects your ears down, think through which double entry transaction thing should we do to affect this part here? Unless it is netting off, that maybe it is increasing your reserves, your revaluation reserve, and reducing your retained earnings, unless in those circumstances, or where it is increasing your cash and reducing your assets because you have sold some of your properties, and it is not affecting this last component. I think she has put. Yes. I like it so much. So this part, what you're seeing here is, yes, you have the cost, you have the profits. There could also be some amortization of some kind of impairments. If there are any impairments, you subtract those impairments. This value comes and sits in here, specifically under a line called investment in the associates. But sometimes they may not segment the investment in associates and investment subsidiary, or just say investments. So it's up to you to segment them when you're doing your computations. Meaning that if you put this number here down, you have a problem to balance it. To balance it, you will not balance it by this part, by this adjustment here. And this is why this adjustment goes into working 5. Look, Victor, you get me? It goes into working 5, the profits and whatever that you have found under group retained earnings. So that these numbers, these two numbers that may cause an imbalance, they would have found themselves here to balance your balance sheet.
Okay.
And I've always said it, that if there's anything that is so easy to balance, to do in the exam, is to balance the balance sheet. As long as you know that this particular transaction that I've done, how does it affect the eyes and the ears? You can even go and hard code the number, put it there. This thing balances. But have you done the correct thing? Because balancing is very easy. But have you done the correct thing? That is what you need to know.
Okay.
So that is working 6, which was never looked at. We are waiting for this moment so that we appreciate what associates are. So it means that that Excel question, guys, I would want you to do it. Immediately we are done here. This is why this class is short. Once it is done, tomorrow we meet, we look at it. Then you also look at the other question.
Okay.
Okay.
So there may be some other issues. Which we looked at already in the previous classes that we've had. This part, the cost of investment, we looked at it. We said it can be cash, it can be share for share exchange, and all these are things, deferred, contingent. If it's deferred, we are saying it's at the present value because you are promised to be given cash at some future date. But because you want to make a decision today, you want to cost that today, you discount it to today at present value. Then contingents, we said, is basically the fair value. Here on the share exchange for shares for share exchange, we did mention that first you need to determine how many shares you have acquired, how many have you issued to the subsidiary, what's the value of these shares, then record them, come up with your double entry. We looked at all these things. Other issues, there could be a mid-year acquisitions. We are saying, calculate the subsidiaries' retained earnings at acquisition, assuming subsidiary profits in the year accrue evenly. Say at the end, the financial, the income statement shows that you have, at year end, the profits that were made were maybe 20. And you acquired this company maybe in February. So after February, you can prorate because you're assuming that the profits are evenly distributed month by month or throughout the year. So you will know that for 2 months, it will be divided by 12 times 2. This will be at pre. At post, it will be 10 times 20 over 12. So you're able to do these assumptions, physical assumptions on the pro rata, or using pro rata, sorry. Uniform accounting policies. So these are just some few things when you're dealing with a theoretical question, just to intimidate the examiner, the markers. Because what I've observed, an examiner, if doesn't understand what the student has done, they will mark you right. And I'll give this reason. As long as you've written it with confidence, from wherever you are writing, you are not putting a lot of garbage. The assumption there is that in an event that I mark this wrongly, then this student then now goes and petitions for a remark that will be given to a different examiner who will see it different. I may be exposed. So they don't want to find themselves in those problems. So on uniform accounting, so I'm saying that if it's a theory question, you have to push in these things. You're not spitting wisdom, you're just spitting wisdom. to convince your examiner that you know what you're talking about. But make sure you don't spit garbage which he can see and he can mark you wrongly with the confidence. Then you will continue marking you wrongly. So you're saying subsidiary must adopt the parent's accounting policies in the group accounts. It's just fair that if I'm a parent company, the policies that we have, they should be a reflection of the policies that our subsidiary companies have. Because otherwise, if we don't have uniformity in accounting policies, we'll have problems. Imagine as a company, as a parent company, you're actually using double declining method or reducing balance method, depreciation, then they're using straight line. You will start having these problems. So it's just fair that there's uniformity in the way accounting policies are done. Then there's this called conterminous year ends. Here the assumption that the subsidiary and the parent company, they will have the similar accounting calendar. But again, what it says is that even if there's a difference of say 3 months, some maybe they go up to March, the other one goes up to December. The other 3 months, they can do their projections and vice versa. So it says financial statement within 3 months of the parent's year end can be used and adjusted for any significant events. You can adjust that. But then I go on to try and put this so that you know the explanation, you know the meaning of this conterminous year end or what this word means. But don't go and use it in Zimbabwe and Botswana in a normal conversation. Look, don't use those big words.
Yes. Okay.
You know, every country has one politician who uses big words. Here we had some
Yes.
So every country has that. It's never short. Or people want to use the big dictionary words. Yeah. So I saying conterminous means having same boundaries or ends. So conterminous accounting period means that parent company's accounting year end is same as subsidiary's accounting year end and vice versa for non-continuous year end. So you may have some differences where one ends in December, the other one ends in March, but it's just a 3 month difference so that you can do your adjustments on major events. So other issues would be, you're a parent company, yes, you bought majority shares, but you cannot consolidate. Why? So the subsidiaries are not consolidated if it is one, held for sale under IFRS 3. So this particular subsidiary is held for sale, they want to sell it. So you cannot consolidate. Secondly, operating under long-term restrictions. such that the parent company cannot exercise control. So there are long-term restrictions that the parent company may not be in the position to exercise control. And these are the issues that I just wanted to bring to the fore. Is it okay?
Yeah, it's fine.
Yeah. Okay.
Then the other question that I gave you is the word question. First, you have to start the Excel, then you go to this one. Like I've always said, guys, do not fear to make mistakes, because you will only make one mistake maybe on associate line, but you will not make a mistake on goodwill. You will not make a mistake on NCI. You will not make a mistake on all those. And you have to do that. You have to learn to start. You have to learn to be defeated, or to get these defeats, so that it pains you when you go into the exam. You are not interested in defeat anymore, because you have been defeated before. They say world champions, they lose fights in trainings because they want to fight with the best. So there will be a component on other components. The treatment again on other components of equity is the same as on the group retained earnings. They will always, you always get 100% from the parent company. Then the post arrangements, you get them from the subsidiary. So you cannot get pre for the subsidiaries, for a simple reason that those were factored in already at the time you were acquiring the company. And this is why you do that goodwill thing. So I'm saying other components of equity is an additional reserve that constitutes any reserve that does not go into retained earnings. It could therefore include share premium, revaluation reserve, gains and losses on fair value through other comprehensive income investments. So this part, it sounds as FRI, sorry. FRS 9. So I think the group accounts is treated in exactly the same way as the group retained earnings, which obviously you pick your 100% like I've mentioned, then you pick your post acquisition for the subsidiary. Always. So let's just go to the Excel question. I guide you what to do. I guide you on what to do. If tomorrow we're meeting, that will be the first thing to look at. But I'd want you to do all those 2 questions and make mistakes if you can, but make sure that you don't. But if you can, just make those mistakes. Okay, so the question reads, can be a public limited company operates in the manufacturing sector. The draft statements of financial position at the 1st December 2019 as follows. So I've been given that. Our area of interest, mostly, you always need to concentrate on things like this. On investment 1540. So you know that this is connected to where? To this part here. Victor, isn't it? Always.
Yeah, yes.
The following information is relevant to the preparation of the group financial statements. On 1st January 2018, Cambodia acquired 70% of the equity. So we mark this of the equity interest of Tukuta for a cash consideration of 1340. So now we have this 1340. In there we have, is it 1540? Let me do this. Under the investments, let me do this. It's 1540.
Yes.
So you know that there's an accounted for value of 200, which you need to search. So you're trying to search for this 200, isn't it? That under investment, if the investment in the subsidiary was 1340, meaning that there's some other investments which is not part of this particular transaction, which came in. Was it a joint venture? Was it an associate? But there's an accounted for value of 200. While you're reading, you are doing this searching of, you are finding gaps in terms of the numbers. You're finding gaps, and you're trying to ask yourself huge questions or difficult questions. Where is this 200? In which other organization did the parent company invest other than this subsidiary? At 1st January 2018, the identifiable net assets of Tukuta had a fair value. At 1st January 2018, the identifiable net assets of Tukuta had a fair value of 1850. So we know that at acquisition, this is what was there. So these net assets, you know the tricks that in here, you have shares, RE, and any other components of equity, which may be sitting in the balance sheet. So you are just being guided by this component here under equity. That's in, you have share capital retained earnings. At the time, the net assets of Tukuta had the fair value on retained earnings were 450. So you have those numbers already. So that 1st January, when the identifiable net assets of Tukuta had a fair value of 1850 million. And retained earnings were 450. So you know about it, 450. Then you also need now, if you have 450 as retained earnings, what were the shares? The shares, it was 1,000. So already you have an idea of what goes into working tool. Look, are you getting me? Then you are told the earnings in fair value is due to an item of property, plant, and equipment that has a remaining useful life of 10 years. Remember that this one gives you 1,450. But then what you are being told is that it's supposed to be 1,850. But the examiner is good-hearted. Has told you that this difference, 400, is coming in as excess fair value from the property, plant, and equipment. That has a remaining useful life of 10 years.
10 years.
And because it's starting from 1st January, always pay particular time, attention to timings. 1st January 2018. You are reporting on the 1st December. 2019, meaning that this gap it's how many years? It's 2 years. So if you have assets that were 400 property, plant and equipment fair value, it means that because the economic lifespan for this is 10 years. So every year is 40. So it means that it is 2 years, it's times 2, giving you 80 as depreciation. So when you do your net assets in the subsidiary, you have now down there, after having your share capital, retained earnings, you also have fair value for your property, plant and equipment, which will be 400 down there. Then you're going to make your adjustment down just below the fair value for your depreciation of 80. And then you do your computations. I don't know if you're getting the story.
Yes.
I'm being deliberate in the way I'm explaining these things so that I want you to try and make some few errors. So we are told it is a group policy to measure non-controlling interest at acquisition as a proportionate share of fair value of the subsidiary's net assets. So we know that whatever we have here, a component of it will go to NCI. On 1st July 2019, Cambridge acquired 25%. Look at this, this is mid-year. So meaning that 6 months after the start of the financial year, Cambridge acquires 25% of the equity interest of Bain for a cash consideration of 200. Now we have found this 200, which we are looking for. But it's not always that the examiner will give you this. Sometimes the examiner can be silent on it. You should be able to know, as long as it hasn't told you that any other investments other than the acquisition of the subsidiary and the associates. If you haven't been told about any other, then you know that that difference should be given it to the associate. Bain's profits for the year were 80 million. Out of which a dividend of 20 million was declared. So you know that if it was 80, after post-acquisition, after 6 months, you get 40. Then what now goes to the associate will be just 25% of that, which gives you 10. And you know that this 10 will definitely increase what? Your group retained earnings. Out of which a dividend of 20 million was declared at 31st December. So this 20 million, again, you only pick a portion of that, which is basically 25%. You don't prorate, no. Which gives you 5. This 5, what is this 5 going to do? The 5 is going to reduce on your group earnings. But it is also going to adjust your net assets, assume so. Prepare the group consolidated statement of financial position of Cambridge as at 1st December 2019.
On the same question.
Yeah?
Can you put in the presentation that you are presenting? I want to ask something on the investment in the associate. There's a working that I didn't get. There's a 40. There's a 40 which you had put there that I didn't get where.
Okay, let
how
me
you
just do
calculate
this.
it.
So, where is it? Where is it? Where is it?
You had removed it. On the 80 million, it was it.
Okay.
Was there was a 40 million that you put? Did we say?
So we are saying on 1st July 2018, Bain's profits for the year was 80 million. So you are starting from 1st January to 31st December. So they made 80 million profit, isn't it? But when was the associate acquired? The associate was acquired
1 July.
On 1st July.
Oh, okay.
So you have 6 months here, you have 6 months there. So half of this after acquisition, which is for the, because the first half you can't claim it, you were not there.
Okay.
So that is how that 40 comes in. But this 40 then, for the associate, you are an associate. You only 25% claim 25% of it, which is basically, what is the 25% of this? It's 10, eh?
Yes, 10. So, is it clear? I know when you start now dealing with this question, if you want, you can even, it's just after church, you just sit and look at the question, then do the other question so that we try to move faster. Then you can actually send. I know I owe you those 2 questions that you submitted, the solutions, so that we can look at them as a package. It's okay.
I'll appreciate if I can be given in the evenings or somewhere there, so that we package them and analyze them.
That's okay.
So once we are done with this, if tomorrow we are meeting, I don't know if we are meeting, if you need some free time, you can just let me know. We'll go into the income statement. Once we are done with the income statement, then we'll go into complex groups.
Okay.
So checking out, Victor.
Yeah, interesting. Like the part that I asked, you know, these are some of the things that you don't pay when you are in an exam and you don't know the basics. You won't be able to pay attention to the debts. Like on this one, you're going to calculate 25% of 80 million. Automatically, you're getting it wrong because of not paying attention to the debts. So once it's done like this, the storytelling, like what you have done, when I see every question like this, in my mind, it has already been mapped. I'm going to pay attention to the debt. So it's interesting for me.
Sure.
Yeah, when I'm going to do the question, I think I'll get more tricks.
You will, yeah. Okay, look, checking out.
Yeah, I think Victor has taken words out of my mouth. It is an interesting in the way of you explaining them to us, eye-opening, and makes it easier for me in particular to grasp the basics and also look at the other, I would call them silent points, where you need to pay attention to the dates that conferred or in the question. So I think it will help me when I'm faced with a similar question in an exam setup or any setup.
Sure. Okay, so end program tomorrow, or you want to have time for yourself?
Look, are we able to do same time tomorrow? Is it okay?
Yeah, it's fine.
Okay.
We can
Tomorrow is
do it
Monday,
same
right?
time tomorrow.
Yeah.
Yes,
Mm.
it's Monday.
Yeah, it's okay.
Okay. So agreed tomorrow, 8 hours.
Yes.
Yes.
Okay, so thank you so much for today's class. I'm sure in the next few hours, you'll be able to have access to this video on YouTube.
Okay.
All right. It's
Thank
okay.
you.
Thank you, Coach.
Thank you.
Okay.
Thank you.
Thank you,
Luke.
Coach.
Yes, look.
All right. Thanks. Cheers.